In that particular case, it would probably cause someone to reject a system, and it may be perfectly good.
Welcome to Better System Trader, the podcast to help systematic traders of all levels improve their trading. We'll give you loads of expert tips and practical advice on system design and validation, money management, trading psychology, and many other topics. Whether you're just starting out or a savvy systematic trader, we're here to help you improve your trading and find more success. This is Better System Trader with your host, Andrew Swanscott.
Hi there and welcome to Better System Trader. I hope you've had an awesome week so far. Now, as you've just heard there at the start, that bit of audio was Dave Walton from Statistrade, and Dave's the author of the paper Know Your System, Tuning Data Mining Bias to Benefit Through System Parameter Permutation, which won the Wagner Award for 2014. Anyway, Dave was explaining that there are some situations that can cause traders to throw away trading strategies that could be perfectly viable. Imagine that, putting all that hard work and effort into building trading strategies, but due to some arbitrary decision we're making during the strategy creation process, we could actually be throwing away perfectly good strategies without even realizing it. So, what could be causing this? And what's the solution? Well, I guess the first step is awareness. So let's hear Dave explain what this danger actually is so we know what to look out for. And then towards the end, we briefly discuss one of the solutions to this problem. So we pick up the conversation with Dave talking about techniques to address data mining bias. Yeah, okay. So I guess there are a number of other approaches to validating trading systems. For example, Monte Carlo analysis, out of sample, walk forward. So do they address these problems of data mining bias that we're talking about?
Well, let's start with out of sample testing.
Yep.
Now, and this is really the gold standard, I think. It's very quick and easy to do in theory. And I'll come back to the why I say in theory. And it does, if it's done properly, does give you an unbiased estimate. So, your out of sample performance is not subject to data mining bias because it's held aside. But there are limitations to the approach. The main thing is when you do out of sample testing. Unless you're talking about your out of sample being you're going to trade the system live and gather that data over time. But most people, they set aside some section of data and they hold that as their out of sample. And somehow they determine where they're going to split that data. And from what I've seen, for the most part, it tends to be somewhat arbitrary on where that data split happens. But that data split is where you decide to split the data is actually critically important to the outcome. You can imagine if you have years and years of a bull market and your system is something that you've designed to work well in bull markets, and then all of a sudden right where you drew the line or close to it, as far as your out of sample data, then it shifts to a bear market. You can imagine that your out of sample performance is not going to be representative of what you might expect had the market conditions stayed the same. So that split can be very misleading. In that particular case, it would probably cause someone to reject a system, and it may be perfectly good. But there's also the converse where, it's all of the data is, say, a bull market, and you do a split in the bull market, and everything looks good out of sample, and you expect that to continue, right? And then, of course, most people also make the out of sample period somewhat smaller than the in sample as well, so you have much less data to draw a conclusion on. But I would say the worst thing about out of sample testing is a psychological problem, meaning it's almost impossible for someone not to cheat. And what I mean by that is, and this goes back to my comment about coming back to if it's done properly, you're developing a trading system, and you do your diligence, and you actually hold the out of sample data aside, and you don't cheat, you don't have data snooping into that. You like what you see from your in sample. So, and then you run it on the out of sample, and you do not at all like what you see as far as performance. So then you have a choice at that point. Do you give up and say, okay, I'm going to do something else, not, and i.e. not doing a trading system, or do you start over? And if you start over and you're using the same data, well, effectively what you've done is made that out of sample data in sample. Yeah. And the more you do that, obviously, the bigger the problem you have.
Yeah, okay. We'll just jump back a little bit for a second. So on the splitting of the in-sample and out-of-sample data, I know some traders who actually choose some in-sample data for different types of market conditions. So, for instance, they'll take a slice of a bull market, a bear market, a sideways, and also different kind of volatility regimes, and they'll stitch that data together. That'll be the in-sample, and the rest will be out-of-sample. What do you think about that type of approach?
I think that's a much better way to do it. It would be much more representative, assuming the out-of-sample has similar market conditions that stitch together. Yeah. That's a much better way to do it. But the outcome is still, it's a binary decision based on what you happen to see on that out-of-sample. That is just a function of the in-sample, out-of-sample approach.
Okay, well, that's it for this episode. Thanks for listening. I hope you enjoyed the show. Come on over to bettersystemtrader.com. That's where you'll find all the previous episodes, all the transcribes, all the show notes, and all the free weekly trading tips. bettersystemtrader.com.